Hello friends, welcome to learning sessions, and in the previous video we learned about the HQLAs, high quality liquidity assets. I told you about the types of the HQLAs, like we are having the level 1 assets, level 2 assets, and further the subtypes of the same, and what are the restrictions and constraints for managing the HQLAs. Now, HQLAs are very much important if we are dealing with the LCR, that is a liquidity coverage ratio, which is a ratio related for the short-term resilience of the bank, right? For the 30-day time horizon, the bank is to maintain the 100% of the net cash outflows, and that is to be maintained in the form of the HQLAs, that is high quality liquidity assets. So I hope that you must have gone through the particular video and must have learned the concept. And today we are going to cover case studies related to the HQLA, related to the variance, downside potential, duration, and also related to the BIA, that is a basic indicator approach that is used for calculating the capital for the operational risk, right? So please do confirm the audio video quality at the earliest first of all, so that we can proceed with today's session. And if you are new to the video, and in a way, if you liked our content, or if you'll be liking in our content after watching this video, kindly please do subscribe to the channel and press the bell notification icon so that you get updated for the latest updates. And if you want to get the PDF files, case study videos, kindly do download the application which is available at the link on the screen, that is iibf.info/app. So do the needful and start preparation for the same. So let's start and dive into the first case study related to the HQLAs, that is a high quality liquidity assets, and that's related to the LCR. So it's in a way related to the HQLAs and to the LCR. Is that clear? Right. So let me just give you a brief first of all again related to HQLA, so that you can solve the and further you can understand the case study very well. So I told you that we are having the HQLAs, and those are divided into two components. We are having the level 1 assets and the level 2 assets. Okay, and level 2 is further divided. Level 2 assets are further divided into categories, like we are having the level 2A assets and level 2B assets, and level 1 assets are such assets where no haircut is applicable, whereas the overall haircut, maximum haircut, that is applicable to the combination of level 2A and level 2B, that is restricted to the maximum of 50%. That, sorry, 40%. So level 2A plus level 2B total haircut is applicable up to maximum of 40%. And in case of level 2A assets, we are having minimum 15% of the haircut, and in case of the level 2B assets, we are having the maximum minimum 50% of the haircut. And further, the total composition of the level 2B assets in the total we can say pile of HQLAs cannot be more than 15%, right? So these are the restrictions. So these are the constraints that we need to understand, right? That we should be knowing while solving the case study. Okay, now let us solve the case study. Let's come back to the case study now. So it clearly says that an Indian scheduled commercial bank, PQR Limited, reports the following balance sheet and liquidity positions as on the reporting date. So this is related to the balance sheet and the liquidity position. We are provided with the stock of HQLA. We are provided with that the cash with Reserve Bank of India, CRR balance is 18,000 crore, government securities, SDLs, AA rated corporate bonds, equity shares like Nifty listed, and non-financial corporates, right? That's value of the same. And we are also told about the expected cash outflows over the next 30 days over there, right? And also we are told about the expected cash inflows over the next 30 days. So we are given with all such data with us, and let's have a look at the first question. First of all, it's related to that we need to calculate the HQLA level 1. We have to calculate the level 1 HQLAs. Now it might not be clear from the above, right? Which particular thing that we need to calculate, but let's dive into it and let's try to solve it. So first of all, we need to identify the eligible HQLAs, right? Eligible HQLAs. So if I'm talking about the level 1 HQLA, if I'm going to talk about the level 1 HQLA, first of all, let's have a look at the stock of the HQLAs. Stock of the HQLAs. Now, whatsoever the balance that is with the Reserve Bank of India, That is what? That is level 1 assets. That is the level 1 assets. And even if we talk about the government securities, that is related to the level 1 assets. That is also belonging to the level 1 assets. But whenever we are talking about that the government securities are under the HQLA level 1, we should be keeping one thing in mind, that those should not be encumbered. There should not be have any charge created over those HQLAs. That is the thing that is which is required, right? So it is clearly given that the market value of these government security is 42,000 crores, of which pledged for repo is 12,000 crore, right? So we will be having the government securities which are unencumbered to be 42,000 crore minus 12,000 crore, that is 30,000 crores. That is 30,000 crores. So it is 30,000 crores which would be available under the HQLA level 1 assets. Is that clear? Right? So HQLA level 1 over here. And if we talk about the SDLs, that is a state development loans. That is a state development loans. In that scenario, that is belonging to level 2A or level 2B. Level 2A or level 2B. It is related to the level 2A assets. This is related to state development loans, is related to the level 2A asset. This is the receivables that you are going to get from the state, right? And it's related to level 2A assets. But keep in mind, in case of level 2A asset, as I told you, minimum haircut which is applicable is what? It is 15%. So we are to subtract 15% value out of it. Only that particular component we can be considering for the level 2A assets, right? So that is 10,000 crores minus 15%. 10,000 crores minus 15%, and that is 8,500 crores. 8,500 crores. And if we talk about the AA rated corporate bonds, that's belonging to the 2B assets. That's belonging to the 2B asset. And in case of 2B asset, the minimum haircut which will be applicable, kindly do answer at the earliest. I have already told you what will be the minimum haircut which will be applicable in case of the level 2B assets. I told you that in case of level 2A asset, the minimum haircut applicable is 15%. Okay. And in case of level 2B asset, the minimum haircut applicable is what it is? It is 50%, right? So we are to subtract 50% value out of it. Okay. And also we talked about the listed securities and non-corporate non-financial corporates. It's also again level 2B assets. These are also the level 2B assets. So both of these components, number 4 and number 5, these are what? These are level 2B assets. Okay. And we have to subtract 50% value out of it. So for AA rated bonds, 16,000 crores minus 50%, that will be 8,000 crore. That will be 8,000 crore. And for the equity shares value, market value, minus 50% value, minus 50%, that will be equal to 4,000 crores, right? So this is the value that we need to consider. So the total level 2B assets would be equivalent to what? Would be equivalent to 12,000 crore. 12,000 crores. But there were some restrictions. And what were those restrictions? The first restriction that was to be applicable, that's related to the total amount of the level 2B assets. Total amount of the level 2B asset. And that is what? That is, it cannot be more than 15% of the total composition. One thing that we should be knowing, right? And we'll be solving them all. Now you know all about the composition, like you know which particular assets are belonging to the level 1 category and which assets are belonging to the level 2 category, level 2A category specifically, and level 2B category specifically. Is that clear so far? Kindly please confirm, are you clear with the composition so far? Okay. Now let's come back to the question. So the question number 1, it says that we were to tell level 1 HQLA and we were having only one component out of it, and it was mentioned to be the cash balance with the Reserve Bank of India, and it is 18,000 crores. It is 18,000 crores. So we can simply write that cash with RBI, and it is 18,000 crore. And in case of the cash with Reserve Bank of India, no haircut is applicable because it's belonging to level 1 HQLA. So no haircut will be accountable as it is, right? But in case second point that was there, that was related to government securities, the total market value is 42,000 and pledged one is 12,000 crores, right? So it's about the government securities. So second is government securities, and 42,000 crores minus 12,000 crore of the value, right? That was the thing. So it is 30,000 crore. So the total level 1 asset, total level 1 HQLAs, these are going to be 18,000 plus 30,000, that is 48,000 crores. It will be amounting 48,000 crore level 1 HQLA. Okay, now let's move to the second question. Calculate the level of 2A HQLAs. We have to calculate the level of 2A HQLAs. Now, in that particular scenario, we were just having one component, that was SDLs, State Development Loans. What was the value related to it? Let's have a look at it. Level 2A assets, it's the SDLs, that was amounting 10,000 crores. 10,000 crores. So it is 10,000 crores, and the haircut applicable would be 15%. Minimum 15% of haircut is applicable. 15% of haircut. Let me just mention over here so that you can retain these things. Okay. So minus 15% of the value. So 10,000 minus 15%, that is 8,500 crores. Okay. So that would be the answer for the second question. Now, the third one, it says calculate level 2B HQLAs. We have to calculate level 2B HQLAs. Now, in case of level 2B HQLAs, we were having again two components. If I memorize, it was the AA corporate bonds, right? And the another one, it was related to equity, I guess. Equity and non-financial corporate funding, something like that, right? And the amounts, let's have a look at it. Let's have a look at the amounts. So for AA rated corporate bonds, the amount was 16,000 crores. And for the equity shares, the amount was 8,000 crores. So it was 16,000 crores, and further the second amount was 8,000 crores. Is that clear? Clear so far? Okay. So 16,000 crores and 8,000 crores. 16,000 crore is a value for the AA corporate bonds. And for equity, we were having 8,000 crores of the value, right? And minimum haircut which will be applicable in case of level 2 BHQLAs, minimum haircut which will be applicable, it is 50% minimum applicable, minimum which will be applicable, right? So for AA corporate bonds, it is minus 50%, and also for the equity component minus 50%, 8,000 for this and 4,000 for this, right? So it will be equal to what? Total level 2B would be equal to what? It would be 12,000 crores. Total level 2B assets would be 12,000 crores. Okay. But just one thing that you should be clear with, that we are to apply the composition cap. We are to apply the composition cap also. Now, what is the composition cap here? For level 2 asset, let me mention over here. Level 2 asset, the composition cap is, it cannot be in total. We talking about level 2A plus 2B. In total, it cannot be more than 40%. So it should be lesser than or equal to 40% of total HQLAs. 40% should be lesser than or equal to 40% of the total HQLAs. And if we're talking about the level 2B assets alone, what was the cap? 15% of the total HQLAs. Okay, so for the level 2A, level 2B, the cap is 40%, and for level 2B, the cap is what? It is 15% for level 2B. Clear so far? Please confirm. Are you clear with this thing particularly so far? No. We are to solve the eligible HQLAs, final eligible HQLAs we are to calculate, and we are to restrict the values of level 2B assets also. Right? So we are to consider the values. Let's take the case that we don't know the total value so far. So let's consider that we are having the total HQLAs. Total HQLAs we are assuming to be X. Okay. And now we know that the level 1 assets are what? Those are 48,000 crores. And level 2 assets are what? Total. Those, that is 20,500. Because 12,000 from this one, and from the previous one it was 8,500, right? So the total level 2 assets are 20,500 crores. Are you clear with this? Okay, so now we are having the level 1 assets total, level 2 assets total. So total preliminary assets, we can be saying it is 68,500 crores. 68,500 crores. In total, it will be 68,500. This is not final one, but we are supposing it to be final one, first of all. Okay, now we have to check the cap. If we look at the first cap, that is 20,500 crores, that's for the level 2. That is the first cap. Let me write A over here and the B over here. So now the first cap ratio would be equal to what? It will be equal to 20,500 and divided by 68,500. If you're considering the maximum HQLAs are 68,500 crores. So it is 20,500 divided by 68,500 and percentage of the same. So it comes out to be around 30%. It comes out to be around 30%, right? And if we calculate the second ratio, that is level 2B assets, which are amounting 12,000 crores. So 12,000 crores divided by 68500. So that will be the ratio equivalent to 12,000 divided by 68500. That is 17.5%. So which ratio is out of the capping? For which particular HQLA the capping is not maintained? Do answer. I already told you clearly that for this one is equal to 2A plus 2B. 2A plus 2B. And 2A plus 2B is to be capped around 40% maximum. So this is all fine. This is all okay. This one is all okay. But this one, second one, it's related to 2B. And for 2B, the percentage should be maximum of 15% of the total HQLAs. But this is beyond 15%. So this one is not okay. Okay. So we have to restrict the level of the level 2B assets. We have to restrict the level 2B assets. So maximum 2B, which is allowed, is 15% of the HQLA. Okay. So let's now consider that the total HQLA is not X. And let's take the case now it is Y, because we have to reduce the value. Right. But now we do know that the maximum level 2B would be equal to what? It will be 15%. Means 0.15 of the Y of the total HQLAs. It will be the same case. Okay. So the total would be equal to level 1 assets plus level 2A asset plus level 2B assets. So these are the total HQLAs that would be equal to Y. That would be equal to Y. Right? Now here, we are having the level 1 assets that we calculated 48,000. Let me recheck. It was 48,000. Yes, 48,000. So level 1, it is equal to 48,000. For level 2A, we are now all clear. That's also all fine. That is 8,500. But for level 2B, we are not clear. And that is 0.15Y and is equal to Y. Now we have to solve the value of Y. That will be equal to 48,000 plus 8,500. That is 56,500. And Y minus 0.15Y, that is 0.85Y. So 56,500 divided by 0.85, that is 66,470 approximately. This is the total HQLA level. This is a total HQLA level, right? And level 2B assets would be equal to what? 15% of this. So 66,470 multiplied by 15%, that is 9970. So from here we can conclude that the level 2B asset would be equal to 0.15 or 15% multiplied by 66470. That comes out to be 9970. So the question above was that what is a level of HQLA level 2B? So that is what? That is 9970. Answer is 9970. Clear with it? Please confirm. This was not lengthy. We were just to apply the limits. I made you understand, right? That's why it took some time. Otherwise, it's not lengthy. It will be, you can be solving it just in minutes, right? Just in 1 or 2 minutes maximumly. So we calculated the total HQLA 2B now. It is 9970. Now, what is the total eligible HQLAs? Total eligible HQLA. We already calculated 66,470. These are the total HQLAs. Right? Level 1 was equivalent to 48,000 crores. Level 2 was equivalent to 8,500 crores. And level 2B was equivalent to 9970, right? That was 9970. Okay, this is how we calculate it. So if you have understood the case study so far, kindly please give this video a thumbs up. If you have understood the video so far, kindly do give this video a thumbs up. And if you're liking our content, make sure to subscribe the channel and press the bell notification icon. Right? Now, let's move toward the next question. It's now related to LCR. So basically we are solving two topics from this particular case study. One, it was related to HQLA. Now you have understood every single point related to the HQLA. And now it is related to the LCR, that is the liquidity coverage ratio. Here it is given that we need to calculate the liquidity coverage ratio. Liquidity coverage ratio for the bank. Now, first of all, we should be considering, we are to calculate the cash outflows, the total cash outflows. First thing. Then we'll be focusing on the cash inflows, cash outflows and cash inflows. And then we'll be subtracting them. That will be the net cash outflow. That will be the net cash outflow. So this is what? This is your LCR. This is how you can calculate LCR, because this is a denominator of the LCR, right? So this is what? This is corresponding to the net cash outflows. So the first term is total cash outflows. Second term is total cash inflows. We have to get a difference of the same. That will be the net cash outflow, right? And this is denominator. What is the formula of LCR? If you memorize LCR formula, which is to be maintained minimum at 100% as per the Basel updates and as per the regulator, right? What is the formula? It is a stock of HQLAs divided by the net cash outflows. net cash outflow, right? We have already calculated, what? We have already calculated the HQLAs, right? Now we have to calculate the net cash outflow. Okay. First of all, let's have a look at the question now again at the second part. So it says that we are having the expected cash outflow over the next 30 days and everything is given very much clear. Like they tell that runoff is 5%. Means the volatility is around 5%. So we have to separate the volatility out of it. We have to separate the volatility, right? But for outflow, we have to check the runoff factor only. We have to check the runoff factor only. So we'll be calculating this one only. So it will be 90,000 crores multiplied by 5%. So 90,000 multiplied by 5%, that is 4,500 crores. And for retail term deposit, runoff is 10%. So 40,000 crores into 10%, that is 4,000 crores, right? And for the third one, unsecured wholesale funding, non-financial corporates, the runoff is 40%, right? So 40% of 30,000 crore, that is 12,000 crores. Third factor. Fourth one is committed but undrawn credit lines to corporates, 25,000 crores multiplied by 10%, that is 2,500 crores. And derivatives payable, which are net given to be 6,000 and the runoff is 100%, so 6,000 crores. Now we have to add them up all. The first one is 4,500 crores, 4,500 plus 4,000 plus 12,000 plus 2,500 plus 6,000. So that is 29,000 crores. So in total, it is 29,000 crore in total. So these are the total cash outflows. Total cash outflow we are talking about. Clear with this? Okay. So we have to just calculate the runoff factor, at what amount can go here and there. Okay. So after that, it's related to the cash inflow. Cash inflow. And it is specifically given that expected cash inflow over the next 30 days, and as per the Reserve Bank of India LCR norms, inflow capped at 75% of the total cash outflow. It is to be capped at the 75%, right? So total inflows, what we are having? We are having 22,000, 30,000, 3,000. So total would be equal to 20 plus 30, 22 plus 30, 52, 52 plus 3, 55,000. So total inflows are 55,000 crores. Total inflow. But capping is to be done. And capping to the 75% of the total cash outflows. So 29,000 crores multiplied by 75%. 29,000 multiplied by 75%, and that is 21,750, right? So the maximum inflow that can be taken over here, this is 21,750, right? So let's say case if it was 12,000 and if it was 10,000, right? Why these particular figures do matter? Because if the total inflow is lesser than 21,750, then we would have considered the lower value, right? So it's not the case that this value is to be considered. We have to consider the lower value of the total cash inflows or the 75% of the cash outflows. Okay, so that was done. So that's why we solved it, and it came out to be 21,750. So what will be the net cash outflow? That will be 29,000 minus 21,750. So 29,000 minus 21,750, and it comes out to be 7,250. It is 7,250, right? Now, if we are to calculate the LCR, what will be the formula? LCR. I told you the formula. Stock of HQLAs. Stock of the HQLAs. What was the stock of HQLA? Let's just go back again. I don't memorize what was the figure we calculated. It was 66470. So stock of HQLA is 66470, right? And net cash outflow was 7250. I've just mentioned it on my calculator so that I don't forget it. Okay, so it is 7250. We have to calculate percentage. So it is 66470 divided by 7250 percentage. So it is coming to be 917%. It's coming out to be 917%, right? So this is how we can calculate the LCR. Is that clear to you? Please confirm. So just in 30 minutes, we learned about the two major concepts. One, it is related to the HQLA, and the other one, it's related to the LCR, liquidity coverage ratio, right? And LCR to be maintained at what percentage? It is to be maintained at 100%. So the bank is actually following the guidelines, right? Minimum percentage is to be maintained at 100%. Maximally, the bank can be maintaining any number of the percentages or any percentage of the LCR. No worries in that. So that is how we can solve such questions if those type of questions are being asked in the exam. So do not just look at the case study that the huge text are there or something like that. You should be paying attention toward the concepts, right? So if you have liked the concept so far, if you're able to understand the concept, do give this video a thumbs up. Do like this video and share this video with your friends and colleagues who are preparing for the CAIIB 2026. Now we have solved one question, and now the other case study that we are going to solve is related to the basic indicator approach. I have committed to you that there will be session on 9:30 a.m. on Sunday, and we are taking that particular session. And the second case study that we are going to solve today, I told you that one case study will be solving on HQLA and the other on the basic indicator approach. But let me tell you that we'll be solving another case study that is going to be related to the VAR, that is from the chapter 1 of the module B. We learned about the VAR somewhat. That will also be covered under the chapter number 3 or chapter number 4, right? But it's very much important. Okay. Now, let's solve another case study. So it says that the following data relating to the bank is given. Estimate the likely capital funds required by the banks as on 31st March 2020, taking into account the Basel considerations, implementations of the Reserve Bank of India. The risk-weighted assets of the credit risk likely to be 72,565 crores, and capital allocation for the market risk is 150 crore, and for operational risk gross income of the bank is 4,000 crores as on 31st March 2018, 4,500 crores as on March 2019, and 5,000 crores on March 2020. So we are provided with such data and we have to solve the questions based upon it. So the first one, it says, as per the Reserve Bank of India directives, what is the minimum capital adequacy ratio and the tier 1 capital the bank is required to maintain as on 31st March 2020. So the first one, it says that as per the Reserve Bank of India, minimum capital adequacy ratio and tier 1 capital, what the capital the bank is to be maintaining. Anyone, if you can answer me for the same, because I have already conveyed the idea to you that how we can be solving such questions. In the last video also, we solved a question related to the capital one, right? So if you're having any idea, please try to answer. The more you'll be able to participate, the more you'll be memorizing. So it's very much easier to retain, right? So I told you about the different components of the capital. I told you about the different components of the capital. What were the components? We were having the tier 1 capital, and in tier 1, the minimum CET1 is to be maintained at 5.5% as per India, and AT1 is to be maintained at 1.5%. Tier 2 is to be minimally maintained at 2%, right? So the total minimum capital is to be maintained is 5.5%. 5.5% is 2%. 2% is 5.5%. 5.5% is 2%. 2% 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 is 9%. It is 9%. And for tier 2 capital, it is 2%, right? So total tier 1 capital would be what? Total minimum CET1 is 5.5%. And for the tier 1 capital would be 7%, because tier 1 is equal to 5.5 plus 1.5. So it is 5.5% and plus 1.5%, that is 7%, right? That is to be maintained. But just keep in mind one thing, that here they have told us the capital adequacy ratio, minimum capital adequacy ratio. So minimum capital adequacy ratio is 9%, not about the CET1. They are talking about the minimum capital adequacy ratio. So it will be 9%, right? And let me just tell you that in case of the Basel guidelines, we are not just to maintain the CET1, AT1 and others, we are also to maintain the CCB, right? But whenever it is asked in the question about the CAR, we have to just worry about the first two components. That's tier 1 capital and tier 2 capital. We are not to consider CCB, triple CB a part of it. Those are to be maintained separately, right? Those are to be maintained. That's mandatory. So that the banks are to maintain 2.5% of the CCB, capital conservation buffer. But that's not the part that we are to involve it under the CAR. Okay. Second one, based on the gross income as above, calculate the capital charge for the operational risk. Capital charge for the operational risk. Now, whenever it's related to the capital charge for the operational risk, and specifically in the question it is given that the bank is to follow the basic indicator approach, that is a BIA approach. The banks are to follow the basic indicator approach. And when the banks are following the basic indicator approach, in that scenario, how we need to solve it? I told you very clearly that we have to calculate the average of the gross income over the 3 years. Average of gross income for 3 years. We are already provided with the gross incomes, like for first year 2018 we can consider, second year 2019, third year 2020. So it is 4,000 plus 4,500 plus divided by 3. So the gross income would be equal to, 4,000 plus 4,500 plus, and it comes out to be 4,500. So the gross average income is 4,500. It is 4,500, right? And the step 2 would be related to what? As per the Reserve Bank of India. It is fixed at what percentage? Alpha. The alpha value is fixed at what percentage? It is fixed at 15%. It is fixed at 15%, right? So the average value we calculated, gross income, it is 4,500 crore. Then we multiplied it with the alpha, that is fixed at 15% as per the Reserve Bank of India. So that is a capital charge for the operational risk, coming out to be 675 crores. 675 crores. Right? And if we are to calculate the, let's say if it is given that we have to calculate the risk-weighted assets, because this is a capital charge. Right? We have calculated the capital charge here. And if we have to calculate the risk-weighted assets for the operational risk, what would be that? If we were to compute the risk-weighted assets for the operational risk, in that scenario, we will be multiplying capital charge with 12.5. So capital charge is 675, multiplying it with 12.5, and that would be equal to what? That would be 8437.5. We had to maintain the capital of 675 crore for the operational risk. But if it is asked in the question anyhow that we are to calculate the risk weight assets, it would be the capital charge is to be multiplied by 12.5, and that will be 8437.5. 8437.5. Okay. The next question. What is the total capital funds requirement of the bank for covering the credit risk as on the March 31, 2020 to comply with the Basel III norms? Total capital funds we are talking about now, right? We are talking about the total capital funds here. Now let's have a look at the question statement first of all about the capital risk. Credit risk, sorry. For credit risk, we are provided with the risk weight assets. Those are mentioned to be 72565 crores. 72565 crores. Okay. So we can simply mention RWAs at 72565 crores and minimum 9% of the capital adequacy ratio is to be maintained. So 72565 multiplied by 9%, that is 6530. So the total capital funds which are required to be maintained for the credit risk, it would be 6530 crores. Right? But this is representing the minimum capital. Minimum capital. But because in the question we are not given with the capital data of the bank, if we are provided with the different components, that we would have calculated like the maximum capital, but we are not provided with such data in the question. So we'll be limiting it to the minimum capital requirement, right? So this is how we can be solving. Further, what is the total tier 1 funds requirement of the banks for covering the credit risk on as on March 31, 2020? Total tier 1 funds. What is the amount of the total tier 1 funds? Now the tier 1 funds are to be maintained at what percentage? The tier 1 funds are to be maintained at 7%. CET1 and 81. Minimum at 7%. Right? So what would be it? It will be 72565 multiplied by 7%. 72565 multiplied by 7%, that is 5079. 5079.5. This much capital is to be maintained for the risk-weighted assets. Okay, but let me just reiterate the same. If the in question they asked that the if in question they would have asked what is the minimum CET1 to be maintained, then what percentage you will be calculating? Kindly do reply in the chat box. If it would have been related to the minimum CET1, then what capital the bank was to maintain for the credit risk I'm talking right now? It will be 5.5%. If you would have calculated 5.5%, you must have calculated the wrong answer. Why? Because CET1 is to be maintained in the form of CCB also. So we have to add another 2.5% to it. So it will be in total 8%. And what will be the answer? 72565 multiplied by 8%, it would be. That is 5805 crores. 5805 crores. Are you clear with this? Please confirm at the earliest. Are you clear with this particular part, component? Right? So this is how we are to calculate the things. So that was the second case study. Right? So that will be all related to this video. I hope that you must have understood the concepts. The next video will be there tomorrow at 9:15 p.m. in the evening. Right? So make sure to watch all the videos and do subscribe to the channel, press the bell notification icon, and do share this video with your friends and colleagues who are preparing for the CAIIB exams.